And now we have a hot panel about the exit. I think that's the hottest word when you are working on the startup, right?
All right, John, you're still staying on stage. Go get some water. I think 5 bottles should be enough. 5 bottles of water. Thanks. Here are some microphones.
OK, so as we always do, maybe before we can make a quick intro round. Ravi, that's wise for you today, but just to remind what we are doing, to introduce ourselves a little bit before we start talking about the exit, because here we have 2 sides, right? We have a startup that had an exit, and we have investor side. So if you could closely introduce, like Emily, you exited with Fuzi, right? Yes. Could you briefly introduce how the process was and what happened?
Sure. So my first company, Fuzi, that I founded, I started that company in 2008, and we sold it in 2012. The process for us was certainly an interesting one. I think that, I guess the theme maybe for me up here will be I'm very anti-acquisition, but we can get to that in a little bit. But we sold the company. We spent about a year of the company transitioning our product over. And that's about it.
Yeah, but like I'm just wondering, we have a pretty young audience, right? We have many students, we have many young startups, and that's usually an ultimate goal, to have an exit. But I believe there is like a little knowledge gap, right? What does the exit mean? You know, like how this optimal process of the exit looks like. And here's an interesting, because we can compare, you know, like from the investment side and from the startup side. So if we could like briefly introduce the concept of exit. What does that happen to you?
What's an exit?
Well, OK, so I've been on both sides, actually. I've had a couple of exits as an entrepreneur, and then I've helped a bunch on the investor side. I mean, an exit, there's basically, well, there's 3 things. Usually when people think about failure, they don't think about it being an exit, but it is an exit. So there's the downside exit. There's the acquisition exit, which is like 90% plus of what happens for most companies, and then there's taking a company public. I actually had an IPO back in the late 90s, so I've been through that process. That is actually not an easy process either, so it's not for the faint of heart. And on the merger and acquisition side, I've helped multiple companies sell at different levels, and it's not always easy, and it definitely takes some work to make sure that you're a good cultural fit for where you want to be. And it's really important, I think, for the company to make that decision. You know, you really, as an investor, what I want my companies to do is build to be great companies. And if they find a great match in terms of an M&A solution along the way, then that's wonderful. And I hope all the parties are happy, but it doesn't always happen that way.
Can I add one poem?
Yeah, that's right. Mute.
Hello.
Technical issues, the usual, no worries, the conferences.
Well,
Yeah.
so just one thing that I wanted to add is an exit is basically how you get liquidity. So as you guys probably inferred, liquidity for your equity in your company. So how you make that convert into cash. The fourth one, which isn't generally mentioned, of getting liquidity, is that you can sell your founder equity into a subsequent round of financing, where just as an investor would be putting money in for equity from the company, they could buy your equity out, a little bit of it out in a subsequent raise. That's not going to happen in your first raise of capital, but it could happen in a subsequent raise of capital. I say that because I always want founders also to keep building out their dreams. And obviously the reason why you might want to have an exit earlier is because of, it is a little bit, you know, there's the dream of sort of winning the lotto. So, you know, we've had, so if I can share one story, as at Alchemist, we've had 3 acquisitions already. When I was at DFJ, when I was on the board of 3 companies that got acquired, and then I have one company that had a big exit, a $970 million acquisition, and then another company which will hopefully go public. But a case in point is that on Alchemist, we had a pair of 26-year-olds from Denmark that we funded last year. They joined the accelerator in August, they demoed in January, and then they got acquired by Cisco in March. And so literally they had been working on the company for about 12 months before they got acquired. This was Assemblage, which Cisco acquired. And so in many ways, I think that's like the dream outcome of, you come to the US, you're building, you have a startup that you're building, and then suddenly you get acquired. The reality of how that process works is that there's a whole bunch of steps that are going to happen before you actually get to that point. And really, the best companies in terms of the mechanics of how it works is that you don't sell the company, you get bought if that works well. And so there's this long process of really, you're not trying to sell your company, but you are trying to, you might be inducing a partner to get so excited to want to come in and acquire you. And oftentimes, it'll initially look like a partnership, where you'll have somebody who like, hey, let's strike a partnership with a big gorilla type of company. And then it'll evolve to, hey, what about an exclusive partnership? And then it can evolve to a discussion of, hey, why don't we acquire you or take you out? And there's a certain dance to orchestrate those steps so that you optimize the exit outcome that happens there. But in general, the potential to build something that's great is always, in my opinion, more worthwhile if you are confident about the business. And so don't forget to not bet on yourself. I can talk forever on this stuff.
But now I'm wondering, usually, there are many comments saying, don't think about an exit, just build your product, work on it, and it will come later. How was it in your case? Did you have any exit strategy, something on mind?
Yeah, I mean, for us, honestly, like, I'm the type of entrepreneur that I build companies because I love running the company and I love creating something and putting it into the world and being able to work on that and be able to build my vision, And I think that there is this allure of the exit, and the media, I think, blows up like the, there's this really small percentage of like big wins where there's a really great financial outcome. And I think that there's a lot more instances where you sell your company and then you go work for somebody else, and like that's like what my experience was it was really challenging to go from being in complete control of running your vision and then being able to turn over the keys to that. And so you have to have something that's so worth it that to give up the part that you love most about being an entrepreneur to sell your company, right? So I think and I think the best entrepreneurs build companies because they truly love building it, and they love actually just working on that product and being able to realize it. So I think that for me, just not thinking about the exit, thinking about just build a great company. Again, I think what you spoke to, it's like great companies are bought, not sold. And that was the process for us, is like people came to us. We didn't try to sell the company. So I really believe in starting from just thinking about building a great company that can stand on its own.
I have a question to John, building on top of that. So as an investor, once you come into the company and the company's like, hey, we love our product, we want to build our business, and you're like, hey, but I also want my financial return to it. Does that change the whole kind of mindset and focus? How does that work?
It's interesting. I sat on a lot of boards last year. I sat on 18, which is about 12 more than I should have, I think. And I've been through many discussions actually on these things, and there's not a consistent answer from investors. So there are some investors who will try to push you to sell if they think that it's time for the company, or they don't believe that you're going to be able to go further. There are other investors who will pretty much back the CEO 100%. I will put myself in that camp. My belief is that the CEO always knows better than me. So if the CEO believes that now is the time to sell, I better be selling as fast as I possibly can, because that's the person who I'm betting on. Sure. And if the CEO thinks that they should keep building and that there's way more opportunity ahead, they know the market better than I do as well, so I usually fall into that camp. So, you have to be patient in this business on both the entrepreneur side and the investor side. And so I think that's the key to this.
And to back all the way up in thinking about the type of company you want to build, I think we don't talk enough about, there's, again, sort of romanticize this notion of raising VC capital and getting on that track. And I think for my first company, we almost got on it by accident because we went into this accelerator program and then we pitched and then people wanted to give us money, so we took it and then we realized, oh, we got on the track. Like, we raised money, now our job is to keep raising money and to sell this because like now we have investors on board, they need a liquidation event. Like, this is actually, unless we could get to the place of being really like IPO and still be able to run it independently, like that's actually our goal now, is we have to sell this. And there are a few alternatives, like a Kickstarter, or there's some companies that they've raised capital, but they're not going to sell, and you can return profits in other ways. But I think that this is a really critical thing for you to think about from the very beginning, is that, you know, we call it like a lifestyle business, and it like downplays it. It's like, it's running a business. It's still building your vision and the thing you want to create in the world. If you want to raise that with capital that's different, crowdfunding, or, you know, AngelList may be an avenue to raise capital from. Raising capital in different ways that you stay in control and you don't have to sell your company. I think thinking about that from the very beginning, what do you want actually, comes before even thinking about an exit, because that's, once you're on the train of raising capital, you are committed to the people that have invested to create a liquidation event.
Yeah. Let me give just a quick perspective on that. So I give a lot of people advice not to raise money from people like me. And no insults to anybody who's a venture investor, but there are very few companies that have the profile for venture, which is you're going to be exponentially scaling, and we're trying to have you sell within 10 years, and most likely trying to sell within 7. So if you don't think that that's the path for your company, then please do not ask any VC for money, because that will end up in a bad situation. It's not good. And I call on the flip side, when I put my VC hat on, the VC hat, I actually am analyzing CEOs when they come into my office, and I call it CEO risk. If I think the CEO is going to sell too early, then this company's not very interesting for me. And so, you know, I'm trying to assess actually whether or not the CEO has it in them to build a multi-hundred million or $1 billion business, because that's what I'm trying to find.
Question to Ravi. So you're obviously like even earlier than that, I guess, in the whole chain, right? So what's the time frame that you're looking into? Hey, you know, this is like 2 years project, this is like 10 years as an accelerator, right? Where do you see the companies, you know, exiting?
Well, ideally they never exit, they go public.
Okay.
Because ultimately we want companies that will change the world. And even if you go public, you can be an enduring concern, and you'll be able to sell the VCs can sell their equity on the public markets. And that's honestly the real answer, is that I want founders that are looking to build enduring companies. Not because I'm a nice guy, but because those companies are actually create the most value. And I am a nice guy. But but you know, if you look at the 2 top performing companies on NASDAQ over the last 10 years, it's pretty clearly been Apple and Amazon. And you know, there's a ton of companies in the United States that have incredibly smart CEOs that have led those companies well. But Apple and Amazon have just dominated the markets. And a lot of people would argue that the reason why is that for 2000, 2010, it was founders that were at the helm of both of those companies, Jeff Bezos and Steve Jobs. And they just continued to do what they always do, which is innovate and keep building and building and building new businesses. That, you know, Amazon started as a bookstore company, now it's a utility computing company. You know, Apple keeps killing industries left to right. And I want founders that ultimately will do that purely for financial return, because they will, I mean, not purely for that, but those that it's aligned with, if you really are at it to change the world, you will inevitably reap the fruits of the rewards of that with the value that accretes to the company. So I'm really not looking for somebody who's thinking, I want to exit in 4 years, or I need to exit in 7 years. I'm looking for somebody who really wants to change the world. Now, just a byproduct of doing that, if you do that well, is that you will have opportunities to get acquired in that process. And that will happen within that certain time frame. And I completely agree that I will support you in whatever decision you want to make as the CEO. And I also just want you to know that you have more potential than you may even realize. And and so sometimes it can be dangerous to think about, oh, I could never be Steve Jobs or I could never be Jeff Bezos. And the reality is that those are just human beings, just like you. And the difference between them and you is oftentimes something as subtle as they will just act or they will just move, and you can do that too. So it's dangerous to mythify these people too much, although they are.
And here, like you were briefly mentioning like the timing for exit, right? Like 4 years, 3 years. And it's really hard to generalize, you know, like most of the founders probably expect their exit in like B or D round, right? Sometimes it happens earlier. But can you see any like general trends or like what type of companies and when they exit? Like if it depends on something, like industries or what kind of startups usually exit faster?
I think the numbers say that the average exit is about 7 years, but I don't know that there's any industry kind of norms that change that across industries. For my experience, the small exits are the ones that go fast usually. So the companies that sell for a couple of million or maybe pretty small numbers are usually the ones that have the quick time frames. It's pretty rare to see these big exits within 2 years or 3 years. Occasionally, but that's the kind of, I don't know, it just doesn't happen very often. And it's usually a patience game. It's usually that you're going to be in this for the long term. And like Ravi said, like if you're trying to go out and change the world and you want to build something and you want to run it, then those are the ones that often end up being the game changers.
Yeah, so it doesn't happen overnight, as mentioned, right? 7 years, that's an average it takes. So even if you raise money yesterday, it doesn't mean like tomorrow you're going to be a superstar. So take your time, guys. Don't lose the patience. Keep on going. Sure.
Yeah. For me, I'm just very curious. I never had exit. I don't have a startup, but I want to know, like when you had Foodzy and you were in the process, like what were the most important, crucial steps or like decisions that you had to make? Or something like just sharing your experience, right? Yeah.
Or like how did the acquisition happen?
No, like more your personal experience, like towards the acquisition and like what decisions you had to take or like how did it feel if something changed? I don't know, like just personal experience from the process of exiting.
So what is my like thoughts on the process of exiting?
Yeah, and what were like really crucial steps in the process for you?
Got it. Yeah. Well, first was just focusing on building something that people loved. Then the second, we didn't engage a process until we had like a really strong player, somebody that came to the table. And actually, our process was kicked off with the Food Network, and they came to the table and actually wanted to do a strategic partnership first. And this is something that we were advised against doing, a strategic investment, excuse me. And the reason for that is that having a potential acquirer as an investor can muddy acquisition offers because you have someone who's a potential acquirer as an investor, and it just eliminates competition. So we didn't want them as a investor, and we said, but if you want to come back and talk acquisition, we'll talk. And so they came back to the table and said, we're interested in acquiring your company, and so we engaged them on that. And we went through actually a 3-month-long diligence process that was the most grueling thing I've ever been through. Talk about, you walk into this, I'm in a meeting with the president, the CFO, 2 analysts, the head of digital, and just being grilled on every number and every decision we've ever made about the company. It was intense, and we spent about 3 months actually working with them. And in the end, when you start an acquisition process, what we learned is that you start a process. If you have a key player that is for us that made us want to go down that path, then there were other people who had come to us at different times that when we weren't ready, we re-engaged them in that process. And just like if you're raising money and you want to get lots of interest around the table and you want momentum and move it all forward at the same time, that was the same thing we did in this acquisition process. And in the end, actually, that deal didn't happen. We had other offers around the table, and we took a different offer. That's a much longer conversation. Yeah. An interesting story for sure.
I think it's a good point, though. One thing to know is that most of the first acquisition offers, or at least more than 50%, fall through. So I don't know that everybody realizes this, but you can actually get pretty far along in a process. You can have an investment banker, you can be deep into diligence, and your chances are still probably 50-50 or less that this thing actually closes.
Yeah.
So it's not sort of a done deal. If somebody comes to the table and says they want to acquire your company, that's the start of a massive, long, painful process.
Yes.
And I guess psychologically, it's one of the hardest one in like.
I think one of the
doesn't get
hardest
through.
things, and if any of you have, there's like fundraising is a little bit similar to this. You're trying to run a company and build your product, and then you're trying to do this other thing, which is like raise capital and have all these meetings, and your attention is divided and you're not focused. And acquisition is even more so, and one of the hardest things is that we had to protect our team from knowing this was going on, because when there's this like company that wants to buy, you know, there's an acquisition possibly that's going to happen, everybody gets distracted and everybody gets emotionally attached. And that's you don't want people to then be totally bummed if it doesn't happen. So, you know, this is the skill you learn as an entrepreneur is the game face. You have to come in and you can't show what's really going on. And especially with the acquisition process, we had completely kept it private until actually they engaged. They wanted to meet the team, and we had to feel like we were far enough along. And you know, probably in retrospect, I wish we had had an offer before I engaged the team. But they wanted to meet the team to make the offer, so it was like. It's a tricky thing, but for sure that was definitely something I learned was we kept the team away, like we needed them to at least be focused on the product and running the company if we weren't. Yeah, so you're certainly running a process. It's, in a lot of ways it is like fundraising, but just at a whole different level with less people that you can get involved at the table.
Ravi, a question like back from like DFJ times, right? A few advices to any entrepreneur that starts going through that process. Let it be most likely acquisition, right? What are the key things? Emily, you mentioned not showing to the team until it's like later in the process. Any advice for?
Yeah, well, I think Emily's point on the process is very important, because I think if you can control and drive the process, and very few entrepreneurs know how to do this because you're never really confronted with it until it actually happens, and then when you do it the second time, you understand better how to protect yourself and structure that. That's really important. So if I had to give just a framework at the very beginning, when you're initially starting out, what I would say is that the first thing is see if there's just first alignment of vision with a partner where their vision of what the company would look like and your vision aligns. If there's not, you're giving away your baby to somebody that you don't even want to talk to. Then if there's alignment of vision, you want to sort of see if there's how big of an opportunity it would be for them to do the acquisition, and have them put forth, is there what we call a zone of possible agreement, where if everything lines up, would this be an exit outcome that would be attractive to you? And then if it would be, then you sort of move to the next step of coming up with mutual diligence items that you're both going to need to sort of proceed to the next step. What I generally advise our entrepreneurs to do is to be even more protective, and you have more power than you realize, because just as you are so grateful to get acquired, the acquirer has the same problem of needing to source innovation. And so you actually have a lot of power in that relationship. So what I usually recommend is that you can have a common question that a founder will have is, I don't want to reveal everything that I have to an acquirer, because if they know my secret sauce, then they can compete with me. And my general recommendation is you have an initial meeting where you share whatever you're interested in sharing that you feel comfortable sharing, but nothing that you don't feel comfortable sharing. Then if they're interested, the next step is that before you share anything else, they need to put forth a term sheet or an LOI or some expression of interest, and they can caveat it with a bunch of diligence items, but you don't move forward until that happens. Once that's put forth, then, and it seems like it's within a zone of possible agreement, then you can move forward with the other diligence items, and in parallel, you're trying to see if there's other acquire prospects that could acquire you. So it's a bit of a dating process where you need to sort of, it's very hard because it's a very intense thing, and it takes a lot of time, but you need to sort of show love to everybody, just like in fundraising. See where the interests are that are coming forth, and then optimize for the best exit outcome. And it's easier said than done, but that's a generic framework.
I think we could talk forever and ever, and I'm pretty sure we're like running out of time. What time is it now?
Yeah, I was just thinking that we still have a few more minutes, and I
Yeah.
guess we should give this chance to the audience.
Exactly.
Right?
Would love to hear some questions. Anything you want to ask, we have a microphone right there. Any questions you have about an exit? Or does everyone want to change the world and doesn't really care about exiting from their business?
It looks like.
Looks like it. So any last sentence as a remark for the...
Also, when you get acquired, you're still going to be working for that acquirer. It's just so this idea of, well, one, the first thing is, I don't believe that you can be a founder just to be a founder. So this whole notion of, I'm going to be a founder, I'm going to make my $1 million, and then I'm going to go back and do what I love, is not a reason to be a founder. I believe that you have to be called into it. So it has to be something that you're relentlessly thinking about at night that calls you into doing whatever you start. It's not that I'm going to be a founder and then find something to do. And then even if you do want to do it for all these mercenary reasons to get money, it's a long process. And once you get acquired, it's not the end there.
To jump in there, like the craziest thing is like usually if with an acquisition, then you start a new vesting process of like all of a sudden you have to earn like what you
think you already
what
did.
you think you already earned after 7 years or whatever. Now they're like, oh, now you have to stay here for 4 years to actually get all that.
Yeah,
and
explain
like,
what that means. What is it? What do you mean?
Oh yeah. So vesting is basically, and this is something that you set up with employees within your own company as well to incentivize someone to stay. So usually the most common vesting schedule is like a 1-year cliff. You have to stay on 1 year to get 25% of the total amount, and then every year after that or to get any of the amount, and then every year after that you're vesting another 25, another 25. 4 is like the most average vesting schedule for like an employee within a company, and then the deals are all structured differently, like with an acquisition of when the vesting schedule is, when you hit certain, sometimes when you negotiate the terms with an acquirer, there's certain revenue targets you have to hit or certain performance metrics. There's all kinds of things they'll tie your actual, whatever the compensation is, to. So I think you have to realize that once you sell the company, that's not it. Like, you're not done then. You have to, there's a lot of time and work you have to put in after that, and you are working for somebody else. And that's probably the hardest thing that I experienced, was going from, I'm in control of driving this vision, I get to make the calls, I get to make the, call the shots. Now all of a sudden I work for somebody, and that was just not fun at all. It honestly, it killed my soul. And I know it sounds funny, but when you're truly a founder and you just love getting up and building something every day, that wasn't worth any bit of money. That wasn't worth anything. It was I'm so unhappy. And I think just remembering that why you're actually showing up to do this every day, that is such an important piece of it.
Yeah.
Not to be the downer, but
they call them golden handcuffs for a reason. I guess there was just one other thing I was going to say, and that was, we've talked quite a bit about the process. It's pretty common for founders to bring in experts as part of this process too. So often after the first offer comes in, you may hire an investment banker or an advisor who can help you navigate this. So it's a daunting task, but there are people whose daily job is to help do these and to get these transactions done. My usual recommendation is to find somebody that you like working with that can help, because almost no founders have that expertise. And it really increases your chances of getting to a deal that people are going to be okay with.
The thing that I found, I mean, you've never been through this process before, selling a company. It's totally new territory. And one of the single most valuable things we had was an advisor who was not an investor, who could be there, that we knew was on our team, essentially helping us walk through. And like you said, to basically saying things you can say no to, information you don't have to give, basically navigating this process. And even with your investors, you have all these constituents that you're thinking about that you have to serve. It's yourself, your employees, your investors, and a deal has to be structured that you're trying to think about what everybody's getting. And if we didn't have that neutral party investor or advisor, we would have been incredibly lost, because as soon as you move into acquisition, you and your investors are back on the other side of the table. In many ways, like you're not on the same team. Like they want something and you want something, and the way the deal gets structured at the end of the day, like, you know, they're not really, you don't really actually want to be getting advised by your investors. So I think like thinking about in the early stages of your company, even surrounding yourself with an advisor that you are building, you know, that can be involved with the company is something maybe in the early stages to think about.
All right. I think as a final message, that's really good. Unfortunately, we have no time. All right, one question, because you really want to do it. How to find a good advisor?
Somebody that's worked with a lot of companies. Like ours was actually an investor who just didn't invest in our company, but really believed in us. It was someone who was involved with Techstars. So for us personally, we met him. He loved us, but it didn't fit in their theme of investments. But he was really smart and had been through this process before. So you want someone that's seen a lot of deals and can look at it with like that perspective. And so I'd say find an advisor early on that can both help you with the specific company you're building, but has experience working with a lot of companies that have gone through exits.
Yeah, you can ask also your lawyer. You can ask your other founders that have been acquired in the past. They'll all connect you into these M&A advisory firms. All these firms are very service-driven, so I would advise you to reach out to 3 or 4 of them, task them with different things to do. They'll do work for you, even if you don't need it right now, and they'll all want to develop a relationship with you because they make a huge commission off of the sale. So if you don't know, just ask and just talk to everybody and give them a little task and then see who you like. But your lawyer will know. Lawyers make a ton of money on M&A. They know who all the advisors are, and your investors will know. Or just reach out to other co-founders. Or if you're a part of an accelerator, we all know who they are within our regions.
All right. Thank you guys so much. I hope you learned a lot. The conference is coming to its end, but the very most beautiful part is still about to come, and that is the finalists of the startup battle. So these are the companies that'll be competing for the prizes, and one of them is a trip to Silicon Valley. So I think the teams are ready. We'll probably finish it off and then ask the first team to come on stage. All right. Thank you.
I can take this. No worries.